Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog / newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about big tech. They have continued to underperform. So thought that we could pick this apart and see what's going wrong, because we sort of talked about it with
Yes.
Google not doing so well and Nvidia also not
So is it an opportunity to
buy.
or is it something harbinger of worse things to come?
So the thing is, when we look at whether to buy a company which is losing market value, we first tend to ask, why is it dropping? Because you don't want to buy a falling knife, as they say.
Correct.
You want to buy a company which is more like a falling pillow, so that you can catch it and then sleep on it comfortably
Yes.
and get a good night's rest.
Correct.
So the idea behind this exercise is to figure out what is exactly causing these companies to fall. Then we look at whether that's going to be something which is going to affect the future of the company. And then we'll look at the valuations and see, is this worth buying? And then finally, we take our call.
Yes.
So that's how we think about it. So let's go through the steps. The first thing is, let's examine the data. Let's see what's going on. So Microsoft reported its earnings in the afternoon for them, but evening for us. And as of the time of filming this video, in a few short hours, we are supposed to get the results for Meta, Apple, and Amazon. And these are some of the biggest. In fact, Apple is the biggest of the Magnificent Seven. So this is going to be an interesting time. And by the time this video reaches all of you, it's going to be out there and we're going to see what happens. But if we can learn anything from what happened to Microsoft and Alphabet, which is Google, it is looking a little troubling for the rest of them.
True.
So that being said, let's look at what has happened to these big five companies. First of all, Alphabet and Nvidia, which are, market darlings because they're part of the Magnificent Seven. Nvidia more than Alphabet these days, have done very well in the market before the past year. But very recently, all these companies have started doing poorly. No one can really point towards what is causing people to sell it off, because if you actually look at interviews of fund managers talking, they're all talking about different reasons. It feels like they're grasping at straws to come up with reasons to sell. So what it seems to me, at least, is that there is something which is going on in terms of people selling. There is some reason.
You know what I think it is?
Yeah.
My basic understanding why investors are selling these companies is because of the uncertainty of what the impact of AI and Nvidia is going to be on these companies. Because Nvidia has created a revolution in terms of its GPU, and it gave the software to whoever wants to use their GPU for free. And that led to the Bitcoin revolution. Now it's fueling this AI revolution. And even if Intel creates a chip like a GPU, everyone's already used to NVIDIA's software coding and that. So there's a huge gap which needs to be filled. So all these companies are dependent on NVIDIA for their intelligent AI chip funding. And second, each of them have got their own competing AI platforms.
Yeah.
And third, we have ChatGPT kind of companies creating their own AI platforms, which are working independently. Until this cloud of AI comes to an understanding, these companies are going to be in trouble. A company like an Alphabet, for example, their main revenue generation is through search. Now ChatGPT is launching its own search engine. I'm not saying everyone's going to jump on board. People still use phones. A lot of people don't even use ChatGPT. So it's not something which is a threat now. But as an investor, with the amount of fanfare this been having on the media, AI and how AI disruption is there, I feel this whole thing fracturing, which you're saying, is because of AI. What do you think?
I hold a different view. My view is that this may be the case, but I think it would have been any other reason. This could be one of the reasons. But I feel like it would have taken much less for them to start selling. I think you're giving them too much credit on why they're selling. I think it's more to do with the fact that it's a game of musical chairs and people are scared that the music is going to stop sometime soon. I think it's as simple as that. I think that the fact is there has been some sell-off by some investor which has caused the market impact at a crucial turning point when the bubble has, enormously blown up, because we know that these shares have gone up by over 900%. Nvidia has. Over a few years, it has gone up by over 900%. So these companies are companies which have shown great growth, still continue to show great growth, but the market has gone overboard. It has, or at least seems to have gone overboard, because they've priced in all the growth which they're showing.
Yes.
It doesn't matter.
I agree on that. The PE of all these companies are through the roof.
Yeah. So, yes, a Ferrari is a Ferrari. I mean, it performs quite well, but what is the price you're paying for the Ferrari versus what is the price you're paying for normal SUV car or normal sedan, 4-seater or 5-seater? The point I'm trying to make here is it all matters relative to what you're buying and what price you're paying. So if this is a Ferrari and you're buying it for 10 crores instead of what it's actually worth, you are making a loss on it, and it doesn't make any sense. You can say that I'm buying a Ferrari, but it doesn't make sense because you could be buying a better opportunity. That being said, I think that people figured that as long as the music continues, I can keep flipping this for a profit. Alphabet's earnings report, mind you, 14% revenue growth in earnings, and the share dropped by 5% the day after. So what?
But the problem there is the 14% earning growth you saw.
Yeah,
it's a past.
Yeah,
right.
Yes.
You have already factored that in.
Yeah.
You factored that in 1 year ago when you pushed the price from that point upward.
Yeah. Agreed.
So, right.
Yes.
So the 5% drop you're seeing, investors not talking about what happened. Right. They don't care about this. They think a year from now, this 14% growth or whatever they did is going to be minus 10%.
That could possibly be the case. And the reason, at least for Alphabet, is another reason is that if the economy doesn't perform well, they're not going to get ad revenue. I mean, like it or not, AI is not Alphabet's biggest business. It's not even a profitable business. It's actually a time sink and a money sink.
Wait, how much of a threat do you think AI is to these companies? In your own assessment, personal assessment.
I wouldn't say that. See, the problem is with AI, it's difficult as of now to really even figure out how it's going to impact the internet. I mean, you have different theories going about, and we can get into something known as the dead internet theory, where people are estimating that human interaction is only going to be a small percentage of the internet from now on. We've broken the dam. It's irreversible. The majority of the internet is going to be ruled by bots. As you can see in the Be Rich comments section, every now and then, as much as we try to moderate it, you end up having bots which tell us that you should be investing in this and that. Please don't fall for that. It's not us. And it's very difficult to even know why he cares about Indian markets. But my point being that, first of all, bots, second of all, AI, and thirdly, it's bots plus AI. Because these bots are powered by AI machines now, which are commenting very human-like comments. And the point of this is that the fact that they are able to churn this out in millions and millions of messages and comments per second. So the idea is that human interaction, genuine human interaction, is going to be a very valuable commodity, which everyone's going to be fighting over. And AI is going to start it's already started training on its own stuff.
Okay.
So,
coming back to this then.
Yeah.
So you don't feel AI is going to be such a huge dent in this? There's more to this than AI.
Yeah, I'm not even factoring in AI because that's going to be a few years away. But what I'm really worried about now is, or not worried, but concerned about, not even concerned, interested in, is the fact that your earnings estimates, or rather, like you theorize that maybe people aren't expecting the kind of earnings we saw before, but analyst estimates are still sky high. They're expecting double-digit growth with Nvidia. Apple is the one exception, actually. Interesting.
Then I think the only reason I can see for this, if earnings is good, the American economy stays robust, and their election seems to go where everyone's predicting it to go, and analysts are happy, the only reason I can see this kind of evaluation fall is maybe because cost of borrowing has gone through the roof. Because these high interest rates have been sitting around for some time. A lot of people have borrowed and invested. They're not able to make those payments anymore. So they're liquidating this high valuation and closing other debt.
This could possibly be the case because you're going to be continuously discounting at a higher rate.
Correct.
The one excuse was the fact that when interest rates were at 5.5%, before the rate cuts. I mean, assuming there will be rate cuts. People assume that, look, there's going to be rate cuts very soon. Inflation data is very good. Jerome Powell's done a good job. And we're going to go back to where we were before, which means that I can just refinance my bets. This is one camp. The other camp now is saying that, look, there's a very real chance that regardless of whether it's Donald Trump or Kamala Harris or Joe Biden was the candidate before, now Kamala Harris, regardless of whoever comes into office, interest rates are going to be stubbornly above 0%. So then the discount rate is also going to be stubbornly above 0% because the risk-free rate of return is what you minimum should discount with.
Right.
And then you should take a premium on top of that for the risk which you're taking on by getting into equities and especially growth. So that being said, your growth rates have remained the same. Your expectations for interest rates arguably may have gone up. Then we have a contender for an answer for why these companies are nosediving the way they are. Because for your interest rate or the discount rate to go up and for you to make the same return that you're making, that means the earnings reports of the companies have to go up from where they were. I mean, something has to give.
Yes.
Because otherwise your rate of return is going to come down. That's the arithmetic way of looking at it. But I think that we'd be committing a fallacy if we look at it in purely arithmetic. Like, this is one arithmetic explanation, but I think the truth of the matter is they were playing the bubble, and though now the bubble seems to be volatile and people are trying to time the exit, I think that's what's going on. Because nothing has fundamentally changed with these companies. These companies are still...
But it's very funny you say that, because the same thing is true when it's pushing the prices up also. There's fundamentally nothing has changed. Like, I see the way Tata Motors has gone up by 20% in the last 5-6 days. It dropped below 1,000 at 990. And from there, it's just been going one way up. There's fundamentally nothing. They've not announced anything. Nothing has changed. Nothing has happened.
Yeah.
But they dumped it, pushed the price down. Now they're raising it by 20% in such a short manner of time. I feel you're right. There's no way you can predict this. It's just markets being irrational and having exuberance.
So the main important thing is that, or another interesting thing is that some of these companies are still trading well above their long-term valuation average.
There's not even looking at value investors' range.
Yeah, and mind you, Microsoft is a company which benefited from the cloud boom. Apple and Microsoft were companies that, if you remember, Apple was the first company to touch $1 trillion in the US economy in market capitalization.
Yes.
How do people think they did that? Because they were in cloud. How do you think Microsoft became as big as it did? Because they were in cloud. There was a cloud boom before the AI boom, and before the cloud boom, there was the .com boom. The point here that I'm trying to make is that I'm not saying that AI, cloud, or .com were terrible businesses. They were great businesses, but business models. But my point here being that whenever a novel idea comes in, it fascinates the minds of
the consumers.
The consumers, and in turn, it starts pushing up the stock price, because this is a buzzword which mutual fund managers as well as hedge fund managers know. If they throw it out in a call, the consumers like, yeah, I think my son's used ChatGPT to generate some recipe for me, so I think this is a good idea. I think this is going to be revolutionary. And the news cycle has picked it up and it's been hammering it away. And there's a quick and easy way to make some money off of the people who want to invest in these kind of funds. And that for that reason, I think that retail investors are always the latter half of getting into a bubble. And today, again,
they're the ones who get slaughtered.
Right. So time and time again, it feels like, in this case as well, it's the retail investors, albeit in the US, who are facing the brunt of this. And to retail investors at home, and now coming to the question of whether we should be considering these companies, I think that we can wait, because Alphabet was at a decent valuation a while back when it was being battered.
But I'm also curious to see how future options expiring has been affecting these also. Because a lot of people could be placing negative bets on these companies for some time.
Yeah.
Because they're in a bubble and people are taking positions to cover their positions.
Yes.
So that also could be pushing.
That's very well possible. And we talked about the yen. We talked about people borrowing in the yen and then paying it off. And coincidentally, let's not say it's a causation. Coincidentally, when the yen appreciated, that's when these companies also coincidentally started declining. We do not have the data.
Yes, there's no correlation. Yeah. We don't know.
Yeah, we don't know. It's only purely correlation. There's no causation involved because we don't know.
Correct.
Yeah.
Shashat said it right.
So we don't have the data for this. But the point being that it's interesting to note that as and when we talk about the yen strengthening, immediately we're putting out a video on these companies losing out. So that tells me that a lot of hot money is stuck in these companies.
Yes, that I agree. There's a lot of hot money stuck in this company.
And us, in principle, don't chase companies which have hot money plugged in them.
No.
And until the hot money funnels out to the point where you have solid capital going into it, it's going to be
wait.
Yeah.
We're not going anywhere. These companies aren't going anywhere. Hot money definitely will go.
And if interest rates are going to be persistently higher, then you're going to have many more opportunities down the road to maybe even pick up Nvidia for much cheaper than it is today.
Yes.
So that being said, that's all I have for you today.
Yeah.
Okay. So we hope you enjoyed this video. If you liked it, please hit the like button below. Please share it with a friend or share it with your family members if you think they have some value to get out of it. That being said, finally, please leave your comments in the comment section below. We do make it a point to read your comments and we'd love to hear from you. Thank you again for joining us on Be Rich.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.